I'm not recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period, and you are prepared financially and psychologically to hold them.
Warren Buffett's motto is buy and never sell. Sounds crazy, right? But his strategy has turned him into one of the world's richest people. In this video, we'll explore the shocking truth behind Buffett's buy and hold forever mantra and see if it's relevant for you in today's market. So stick around and don't forget to subscribe to the channel first. Warren Buffett's investment strategy is built on value investing, a concept pioneered by Benjamin Graham. His focus on the long term drives him to invest in strong companies with lasting competitive advantages. Referred to as a buy and hold strategy, it involves buying and keeping stocks for an extended period. Buffett's stock approach relies on patience, value investing, and a concentration on long-term fundamentals. Let's break down the main components of his strategy. Number 1. Investing in value. Warren Buffett's dedication to value investing, a philosophy pioneered by Benjamin Graham, is a key part of his stock market strategy. Value investing revolves around finding stocks priced below their true worth, allowing investors to understand a company's actual value. Buffett carefully considers factors like growth prospects, competitive position, and financial stability to assess this value. Buffett's strategy is anchored in a long-term perspective, investing in strong companies with lasting competitive advantages. Known as the buy and hold strategy, it involves keeping stocks for extended periods rather than engaging in short-term trading. Buffett believes in giving investments the time to mature. His focus on value extends beyond stock prices to scrutinizing companies' fundamentals. He looks for robust financials, promising growth and a durable competitive edge. This thorough evaluation guides him in making informed decisions about where to invest for the best long-term returns. Number 2. An edge over competitors. Warren Buffett stands out in investing due to his unique perspective on competition. He recognizes the importance of a competitive edge, but directs his competitive spirit strategically. Unlike games such as chess or football where winning is the main goal, Buffett positions himself as an observer. His competitive focus is on investing, a game he knows he can excel in. The concept of economic moats summarizes Buffett's strategy for gaining an advantage in investing. Economic moats represent a company's ability to endure challenges, fend off competitors, and stay profitable in the long run. Buffett understands that investing in businesses with strong economic moats is crucial for sustained success. Buffett looks for investments with factors contributing to economic moats, such as regulatory benefits, network effects, cost advantages, and brand strength. These elements act as a shield against market changes, helping a company navigate challenges and remain resilient. Buffett's approach centers on the belief that a company's ability to consistently generate increasing earnings over time reflects its enduring competitive advantages. By focusing on businesses with these qualities, he aims to secure long-term value and minimize the impact of short-term market fluctuations. Number 3. Long-term investments. Warren Buffett's third principle is about long-term investments. He started by actively finding more investment ideas than he had money for. This led him to sell assets he liked less to fund new opportunities that really interested him. For a while, Buffett operated this way, always looking for good chances in the market. Interestingly, as Buffett became more successful, a new challenge emerged. He had more money than ideas. This shift shows how his investment journey evolved. Now, it's not about a lack of money, but rather having a lot of funds looking for good investments. Buffett prefers holding on to investments for the long term. He often says his ideal holding period is forever, believing investments need time to grow. He sees compound interest as a powerful force that significantly boosts returns over time. This long-term approach is useful during short-term market ups and downs. By focusing on the real value of the companies he invests in, Buffett can handle market changes with strength. This patient and long-lasting strategy contribute to his consistent success as one of the most celebrated investors. Number 4. Evaluation of intrinsic value. Warren Buffett's investment strategy centers on carefully evaluating intrinsic value. According to him, intrinsic value is the total cash a business would generate from now until Judgment Day, predicted by an all-knowing entity aware of the future. This prediction is then discounted at the appropriate rate to determine the business's intrinsic value. Buffett's approach involves projecting a company's future cash flows, considering various factors affecting its financial performance. After estimating these future cash flows, Buffett uses discounting to bring them to their current value. This discounted cash flow analysis is a fundamental tool in determining a business's intrinsic value. The key decision point comes when comparing intrinsic value to the market price. If the market price is lower than the calculated inherent worth, Buffett sees the investment as appealing. This systematic and calculated approach ensures that Buffett invests in companies where he sees a gap between the market's perception and the actual value of the business. Number 5. Having a business understanding. Warren Buffett's fifth principle is about thoroughly understanding the businesses he invests in. He consistently buys stocks, becoming more aggressive when the market goes down. Buffett feels comfortable buying stocks at lower prices. He stresses the value of investing in companies he knows well, avoiding complicated business plans or sectors he finds confusing. Instead, he focuses on markets and companies he can analyze, forecast, and assess with confidence. This approach reflects Buffett's belief that a solid understanding of a business is crucial for making informed investment decisions. By focusing on industries and companies he understands, Buffett minimizes the risk associated with unfamiliar areas, allowing him to consistently make wise investment choices. Number 6. Control of quality. Warren Buffett's sixth principle emphasizes the pivotal role of a company's management team in the broader investment decision-making process. According to Buffett, the quality of a company's leadership significantly influences its long-term success. He actively seeks out executives known for wise decision-making, competence, and integrity in their leadership roles. A robust management team is deemed a cornerstone for sustained business success. Buffett places a premium on the honesty and competence of those guiding the company's direction. By aligning with companies led by capable and trustworthy leaders, his aim is to ensure that the businesses he invests in are well equipped for enduring growth and stability. Number 7. Avoiding market timing or preventing short-term market fluctuations. Warren Buffett's seventh principle focuses on the avoidance of market timing and the resilience against short-term market fluctuations. He dismisses the notion of accurately predicting what will transpire in the market on a daily, weekly, monthly, or even yearly basis. Instead, Buffett adopts a perspective that extends over a more extended horizon, a decade, 2 decades, or even 3. Buffett makes it clear that attempting to forecast short-term market movements is not only an exercise in futility, but also unimportant in the grand scheme of long-term investing. He firmly states his belief that over the course of a decade or more, stocks will inevitably rise substantially. This long-term outlook serves as a foundation for his caution against allowing short-term market swings to influence investment decisions. In the face of market volatility, Buffett's strategy is to reduce the impact of these fluctuations by concentrating on the underlying fundamentals of the companies he invests in. Holding on to equities for extended periods allows him to ride out the waves of market turbulence with patience. This approach aligns with his aversion to market timing, a practice he advises investors to avoid. Buffett's guidance is clear. Maintain discipline and resist being swayed by the transient ups and downs of the market. Regardless of the noise created by short-term fluctuations, he adheres to a patient and fundamentally based approach when investing in firms. By doing so, Buffett places the emphasis on the enduring qualities of the companies he invests in, rather than succumbing to the unpredictable nature of short-term market movements. Number 8. Easiness and reliability. Warren Buffett's eighth principle highlights his preference for companies with operations that are clear-cut and dependable. He steers away from businesses that harbor unclear futures or are heavily reliant on unpredictable variables. This inclination towards simplicity aligns seamlessly with his overarching objective of making confident and well-informed investment judgments. Buffett places a premium on the ease with which he can comprehend a company's operations. Clarity and transparency in a business's model contribute to his ability to make insightful investment decisions. Companies with straightforward and dependable operations are more likely to fall within Buffett's circle of competence, allowing him to confidently evaluate their potential for long-term success. The aversion to businesses with uncertain futures is a strategic move to mitigate risks associated with unpredictability. Buffett's disciplined approach involves avoiding sectors or companies where the future is ambiguous or dependent on factors that are challenging to forecast. By concentrating on businesses with reliability and straightforward operations, he positions himself to make well-considered and confident investment choices. Number 9. Seldom sold out. Warren Buffett's ninth principle, seldom sold out, epitomizes his unwavering commitment to holding onto wholly owned businesses within Berkshire Hathaway. Buffett asserts that regardless of the enticing offers that may come their way, these businesses will not be sold, even if someone offers 3 times the intrinsic value of entities like See's Candy, the Buffalo News, or B. Shimes. Buffett remains resolute in retaining ownership. This stance extends beyond a purely financial decision. It is a reflection of Buffett's chosen way of life. The approach of not selling wholly owned businesses is integral to Buffett's investment philosophy. While acknowledging the possibility of being wrong, particularly in the eyes of conventional wisdom, he remains steadfast in his belief. This commitment is particularly profound when considering Berkshire Hathaway as a whole. Buffett asserts that if he owned 100% of the conglomerate, he would adhere to the same approach, emphasizing that it aligns with the life he desires to lead. Buffett's reluctance to sell equities extends to his practice of holding on to high-quality businesses with solid competitive positions and dependable management for extended periods. This strategy contrasts with the common tendency in the market to engage in frequent buying and selling. Buffett's perspective is rooted in the belief that investments need time to fully realize their potential. By allowing businesses the opportunity to develop and thrive over the long term, he embraces a patient and measured approach to investing. Number 10. Compounding effect.
When we owned it, or even diversified reading, we wanted them all to be compounding, in effect, be compounding machines. That's why people gave us capital. That's why we put our own capital in.
Buffett's 10th principle, the compounding effect, delves into the intricacies of how Berkshire Hathaway handles the distribution of returns to its shareholders. Buffett highlights that Berkshire has never distributed anything to its shareholders. Instead, the company's ability to distribute returns increases in tandem with the rising value of its portfolio of businesses. The internal compounding of returns becomes a key mechanism through which Berkshire enhances shareholder value. Buffett poses a crucial question related to Berkshire's stock value, using the example of it selling for around $105 billion. He considers the practicality of distributing enough cash to shareholders promptly at present interest rates if someone were to buy the entire company for that amount. This deliberation underscores Buffett's focus on ensuring that shareholders receive sensible returns in the context of prevailing market conditions. The power of compounding is a recurring theme in Buffett's investment philosophy. He emphasizes that long-term stockholders can reap the benefits of capital appreciation and the compounding impact of reinvesting dividends. This method aligns seamlessly with his broader strategy of fostering long-term growth, allowing investments the time needed to mature and optimizing returns over the years. Buffett's emphasis on the compounding effect reflects a profound understanding of the long-term dynamics of investing. By retaining earnings within the company and allowing them to compound over time, Berkshire Hathaway aims to create sustained value for its shareholders. This principle reinforces Buffett's commitment to delivering enduring returns and his strategic approach of prioritizing the long-term growth of the businesses within Berkshire's portfolio. Thanks for watching. If you enjoyed this video, consider liking it and stay tuned for more content like this.